Good afternoon. My name is Perrotta, an attorney with the Cannabis Legal Group here in downtown Royal Oak, Michigan. Today I have my esteemed colleague with me, Patricia Meyers. Patricia is a JD CPA, which fits in well with the topic of our discussion this afternoon, which will be tax implication and structuring of businesses for those entities who wish to apply for cannabis license and then obviously operate as cannabis licensed facilities in the state of Michigan. Patricia is fairly new to our firm. This is her first video, so we hope you find it informative and enjoyable. Again, she's a JD CPA, and without further ado, I will hand it off to Patricia to discuss the items at hand, and then we'll open up for a couple questions and a brief conversation at the end.
Wonderful.
So
Thank
welcome,
you,
Patricia.
Andre, and I'm really glad to be with the firm. There's good reason here to be interested about what kind of entity you want to choose when you start your cannabis business. For example, in this particular case, because we're talking about cannabis, it really is different than any other industry that you're looking at when you decide how you want to structure your business and what kind of entity and tax treatment that you actually want to get. When you're in the cannabis business, what you're doing is your business is functioning with a Schedule I controlled substance, which is still federally illegal. And that is why the cannabis industry is treated differently for tax purposes, income tax purposes at the federal level than any other business. And the difference, unfortunately, is not in our favor. Hopefully that will change. But in the meantime, we want to plan properly so that we maximize our ability to be able to earn as much money as we can and not pay any more taxes than we have to, unless you want to, of course. The IRS is very active in auditing cannabis companies. They actually have a list that they work off of, and it's a list of every single license that's ever been issued. It's up to date in every state, and they have a collective, complete, comprehensive list. They go through it. And eventually you will be audited by the IRS. It doesn't matter how small you are, you're on the list if you have a license, so expect it. And one of the reasons why they do that is because the cannabis audits are their most profitable. They, without question, are able to gain income tax from those more than any other industry. And the reason why is because of this difficulty and also because of poor record keeping when it comes to justifying your calculations for cost of goods sold, and even having good record keeping beyond that. So ultimately what we're leading up to here is that for legal purposes, most of these businesses do organize as an LLC, and that's perfectly fine. But you want to consider how you should organize yourself as far as filing your federal income taxes. And here's an example. If you choose to be treated as, for example, an S corporation or a partnership, which is like an LLC, it's all a pass-through for federal income taxes, the difficulty there in the comparison to a C corp is that you're not personally protected for any tax liability that gets assessed against the company because of underpayment of taxes. It could be because of an audit. It could be just because of your operations. You were profitable, which is always good. And oftentimes, there are situations where the company itself doesn't have the cash to pay the tax liability. And you know where that goes, Andre?
Yes.
It goes to the principals. Yeah. It goes to the people who own the company. And it is something for which you are personally liable. And that personal liability attaches to you whether or not you're part of the management, whether you're not, you just have to be an owner. And it will follow you too, even if you leave. It's kind of like something that's attached to you for a long time. And so it's very important because what you want to do is make sure that not only you select the right choice of entity for your business for organization purposes or legal, and that you also select the right way that your company will be treated for income tax purposes. And it will be different based upon your size, how you're organized. It'll be based upon, are you new? Are you established? Do you function in other states? Are you local to one state? And I think when you consider all of those things, I think, Andre, you're going to agree with me. You're going to want to talk to somebody about this. It's too complicated to just, if you don't have the information, to set out on a plan and then later on be surprised.
Exactly right. It lends itself to potential mind traps that you want to avoid as a business professional. Exposure to certain tax liabilities, potentially even tax surprises, which is, to Patricia's point, makes it incredibly important to seek the counsel of seasoned attorneys and tax professionals like a CPA as well. Patricia, you mentioned IRS Code Section 471. Do you foresee potentially the IRS offering some guidance in light of 471 that could potentially expand what could be considered? Because there's a distinction between direct and indirect expenses.
Yes.
And you mentioned the distinction too regarding license type, whether you're a retailer or a grower. Potentially, a lot of you can fit a lot of cost of goods sold appropriation for the growers as opposed to the retailers.
Yes.
Do you think the IRS may issue some other guidance to potentially expand what could be considered indirect expenses that some of these cannabis industries may avail themselves to in order to write off some of their or deduct some of their expenses?
You know, Andre, I wish you worked for the IRS, because that is another reason why it's been so difficult, and that is why companies can't plan as well as they would like to. Essentially, there is not enough guidance out there. They are not publishing what the industry needs, despite being asked to. And I'm not sure exactly the reason why. I know part of it is it's a new industry in the sense that, you know, it's burgeoning now.
Correct.
And there's a lot more involvement by the states, a lot more legalization where there wasn't in the past. So because of this newness, it really hasn't developed a track record of how things occur, and they haven't, you know, published enough guidance. And there's not a lot of incentive for them to do that, because they kind of like the money, and they just increased their budget by 10% specifically to add manpower for cannabis audits. So you're going to have new friends soon.
And I'm glad you mentioned that, and you touched upon it during your portion of the presentation about the bullseye, the figurative bullseye that is on the back of cannabis companies, licensed cannabis companies, not only in the state of Michigan, but in any state where states have begun issuing cannabis licenses. You also mentioned in that regard the appropriateness of keeping meticulous records,
yes.
Specifically tax records. So if you can touch upon that, potentially some, maybe not best practices, but just something to leave our audience in terms of, you know, being aware and being prepared for the inevitable audit that's going to come from the IRS to make sure that you are complying with federal income tax purposes.
Yes. I would say that, number one, to go directly to your question, when you're starting a business, or if you've already started, no matter how far along, you need to have a CPA's guidance that has great, excellent cannabis experience. It can't be somebody who's a CPA who's dabbling, or somebody who's a CPA that doesn't understand the cannabis business, because it's too complicated. And because of that, it leads to extreme risk for material tax liabilities being assessed. And you could be personally liable. And one of the other reasons is that you may keep very detailed tax records, but what it really comes down to is, how do you take care of your accounting records? Are you keeping the kind of detail in your accounting department such that when the state comes in, or when the federal government comes in, any regulator comes in, they're going to be able to get comfortable with how you calculated your cost of goods sold? Because if you're missing things, if you're missing invoices, if the trail isn't there that they can follow, they're not going to let you create it. So it's, you know, at that point, it's a done deal. And that is one of the major reasons why in this particular industry that the IRS audits are so profitable.
Exactly right.
Because the record keeping isn't very good. And that would be one of the strongest recommendations I could make, is to ensure that you're doing that. And that you know, you hate to think about that, because here you are excited about your business, and you know, you just want to do your business. And this is the regulatory, administrative side that generally isn't very fun, but necessary in order for you to continue to have fun. With cannabis businesses too, in this particular situation, the liability for additional tax assessments by the IRS are not small. They're significant. They can put you under, and they have. And that's why it's, really just such an important issue. And I would say that to add a final comment, I think that's important, just to give you an example of a consideration that could be problematic if you don't have the right counsel. Let's say you want to be an LLC, and again, it depends on how your organization is structured. And you're not too small, you're medium, you like the LLC organization because it's very flexible, you don't need the formality of a C corporation and things like that, so that's great. Then you elect the C Corp status for tax reasons, and you do that because you're, let's say, a retailer. And when you make that election, you're doing it because you do not want to have personal liability for you and for any of the members. So right now, the corporate tax rates are low, 21%, and they're going to go up. And they're going to go up, and likely they're going to be higher than personal rates. So the time will come that you will likely want to change your structure and file as a pass-through for income tax purposes, which would be as a partnership. That's how an LLC would file. And you would do that so that you can get the lower tax rate when the C Corp rates go up. But also, too, it might be the fact that the federal government legalizes marijuana and you don't need to be double taxed like a C Corp is and an LLC is not. You want to minimize your taxes. You want to take advantage of that type of tax structure. And if the really positive thing happens that it becomes legal, you don't have a need for it anymore, and then you decide to switch, and guess what happens? If you switch from a C Corp for tax purposes to a pass-through entity, it's treated as a sale of assets with significant tax consequences. That might not be something that you think about if you haven't consulted with counsel in advance and kind of discussed your whole business plan.
Correct.
Because even though I put that warning out there, for some businesses, that might be the best approach. It is very fact dependent and fact specific.
Absolutely right.
So in this case, the way it stands is you've got your tax return, let's say it's a very simple one. You have your revenue there. You want to subtract all your expenses, but you can't. Under Code Section 280E, you can just actually deduct none of them. That is what Code Section 280E says. It says you cannot deduct any expenses related to an illegal activity, which cannabis is. So therefore, and these things have been around for a while, it has to do with illegal activities of all kinds that are still illegal. So this will survive, this code section will go on. But in any case, so what do? Here you have revenue, you don't want to send it all in and pay taxes. There is a section that is constitutionally protected, Section 471, that does allow you to deduct only your cost of goods sold. And that gives you the opportunity to take advantage of deducting that portion. The difficulty with that is, for example, retail operations, all of their overhead, all of those things that you pay for and take for granted now become undeductible. Your rent, your lighting, your heat, all of those things that you need to run your business, the salaries you pay, those are all considered expenses that are indirect and not part of cost of goods sold. So this actually hits retail businesses a lot harder than it hits grow operations, for example, because grow operations can incorporate many of those expenses actually into the manufacture of their product and therefore becomes part of cost of goods sold. So the incentive in the business is to actually fold as much as you can into your cost of goods sold number so that you can deduct more and then report less net income that is subject to tax for federal income tax purposes. But here's where the problem is with that.
And you mentioned the possibility of either rescheduling or descheduling cannabis from its current place at Schedule 1 under the Controlled Substance Act of 1970. So perhaps there is some movement afoot for federal legalization or decriminalization of cannabis. But absent that, I think we'll end on this to kind of wrapping up. The reason why we're here, the genesis of these tax issues is because of Section 280E. And so absent federal legislation that will either decriminalize or fully legalize cannabis, do you foresee the IRS or Congress really passing legislation that will either repeal Section 280E in its entirety or potentially even carve out cannabis, especially in light of more and more states coming online with cannabis legalization on a state level? Obviously here in Michigan, the state of New York just recently passed cannabis legalization. And so, federal legalization is one issue, but from the tax perspective, do you foresee Congress eliminating 280E, therefore allowing deductions for expenses to be deducted, or even potentially even carving out those allowable expenses to be deducted for cannabis entities? I'd like to hear your thoughts on that and kind of as we close here.
That is a very good idea, and it will never happen.
We can wish,
I'm in favor of it. Like I said, you should still work for the IRS. So. The reason why is we all know the name Al Capone. I mean, there are illegal activities that go on all the time. That's what 280E is for, and it will stay with us forever. And Congress has no incentive at all to carve out cannabis, because if they did, they would just make it legal.
Correct.
Because that would be essentially the same effect. And right now, this might be just a point of interest, but not necessarily tax related. It's a Schedule 1 controlled substance. By the way, the World Health Organization, WHO, has moved it from that classification. Yes, it doesn't help us, but it's an interesting fact. But what I'm leading up to is Schedule 1. There's only 2 drugs on Schedule 1. That is heroin and cannabis. So obviously there are politics involved here. Fentanyl is a Schedule 2 drug. Does this make sense? No. I mean, not to me.
But the reality in which we're dealing with is obviously it's still a Schedule 1 classification, and then obviously 280E applies because of that, and then these whole host of all these tax issues then come into play, which the idea is, of course, hire or at least consult with, at a minimum, ideally hire competent cannabis attorneys, but also specifically attorneys who potentially are also CPAs, like Patricia, who can weave through the thorny issues that the cannabis industry presents itself, specifically related to taxes and tax consequences. If you would like additional information about the topics presented in this presentation or any other topics related to legal or tax issues for your cannabis industry, please feel free to visit our website at cannabis-legal-group.com.